Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Micron.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, usually when a company reports earnings, the math is, well, it's pretty straightforward, right?
Usually it's cause and effect.
Exactly, like basic physics. You crush Wall Street's expectations, you make a mountain of cash, and the stock goes up.
Right.
But then you look at what's happening right now with Micron and, the broader memory chip sector, and suddenly those basic laws of market physics, they completely break down.
They really do. It's the ultimate paradox.
It is, because we are looking at a quarter that basically defies gravity. A jaw-dropping 194% year-over-year revenue increase.
Which is just massive.
Pulling in almost $24 billion in a single quarter, and yet right after announcing these staggering numbers, the stock drops.
Yeah, it's the classic sell the news reaction.
Yeah.
I mean, you have a company delivering the absolute definition of a fundamental home run, right? Every conceivable financial metric is completely off the charts. And the immediate market reaction is just a sell-off.
Make it make sense.
Well, to understand why this is happening and, whether this is a warning sign of a peaking market or maybe a multi-year entry point for generational wealth building, we really have to look under the hood of the AI supercycle.
Okay, let's unpack the sheer scale of the financial beat first, because before we can even touch why the stock went down, you and I and the listener, we need to appreciate the gravity of these numbers.
Absolutely. The top line beat was historic.
Right, so we're talking about Micron's fiscal Q2 2026 revenue hitting $23.6 billion. That didn't just beat the Wall Street consensus, it completely destroyed it.
Yeah, analysts were sitting way back at, what, 20.7 billion?
Exactly. They beat expectations by over $3 billion in a single 3-month period.
And, the top-line revenue is massive. But the true story is really what fell to the bottom line. Micron's net profit was $13.78 billion for the quarter.
Which is just...
And in the exact same period last year, they made $1.58 billion.
Wait, really? So they essentially 10x'd their bottom line in 12 months.
Exactly. You just don't see that kind of exponential leap in companies that are already worth, $500 billion. Non-GAAP earnings per share came in at $12.20, whereas the street was expecting $9.31.
Let me pause you there just to clarify for the listener. When we talk about non-GAAP earnings, we're basically looking at the raw operational cash engine of the business, right?
Yeah, exactly.
Like stripping away the one-time accounting write-offs or the stock-based compensation noise to see what the core business is actually generating.
That is correct. It gives you the clearest picture of operational health. And the operational health here is, well, it's being driven entirely by pricing power. This wasn't just Micron manufacturing and selling more physical units.
Yeah.
The average selling prices, what the industry calls ASPs, they surged 32% quarter over quarter.
32% in a single quarter. I mean, it reminds me of a landlord who suddenly realizes they own the only apartment building in a booming tech metropolis.
That's a great way to look at it.
Right. All these massive companies are moving into town to build data centers. They desperately need space. And the landlord realizes, hey, I can hike the rent by 32% right now because these tenants literally have nowhere else to go.
They're a captive audience.
But that raises a big question for me. Is this just a temporary price gouge, like a momentary blip where Micron has the upper hand because of a supply chain hiccup? Or has their fundamental business model permanently changed?
It is absolutely a permanent structural change. I mean, for decades, memory chips were a cyclical commodity. It was a brutal boom and bust business.
Right. You build too many, prices crash.
Exactly. You manufactured as many chips as you could, flooded the market, and competed in this race to the bottom on price. But the AI revolution has completely transformed Micron from a generic commodity supplier into a strategic, indispensable partner. The architecture of artificial intelligence requires a totally different approach to memory.
I want to dig into that mechanism. Why does AI need something so fundamentally different? What is actually changing inside the hardware itself?
It comes down to a concept called the von Neumann bottleneck.
The von Neumann bottleneck.
Yeah.
Okay.
So in traditional computing, the processor is incredibly fast, but it has to constantly wait for data to be retrieved from the memory chips.
It's a traffic jam.
Exactly. It's like having a Ferrari engine, but driving it on a one-lane dirt road. Standard memory is that dirt road.
Ah, okay.
But AI models, specifically large language models, require massive parallel processing. They need to ingest mountains of data instantaneously. To solve this, the industry shifted to high bandwidth memory, or HBM, and advanced packaging.
So, if standard memory is a one-lane dirt road, what does high bandwidth memory look like?
Think of HBM as a towering skyscraper built right next to the processor.
Okay.
And every single floor of that skyscraper has a massive multi-lane superhighway connecting directly into the GPU. So instead of laying memory chips flat on a motherboard, Micron is physically stacking the silicon dies vertically
Wow.
and connecting them with these microscopic vertical channels called through-silicon vias. It is infinitely harder to engineer, to manufacture, and to package.
And because it's so difficult to produce, I imagine the barriers to entry are massive.
Huge. Memory and advanced packaging now make up roughly two-thirds of the bill of materials in top-tier AI GPUs.
Two-thirds.
Yeah, two-thirds of the physical cost of the hardware driving the AI boom goes directly to these memory components.
That's incredible. So they aren't just a side part anymore. They're the main ingredient, like the engine block.
Precisely. And the moat Micron has built around this technology is incredibly deep. We are in a state of absolute structural undersupply for HBM right now. Micron is completely 100% sold out of their production capacity for the rest of the calendar year.
So they've essentially locked in that massive pricing power. The hyperscalers, the Amazons, Microsofts, Googles, building these billion-dollar AI data centers, they can't just easily switch to a cheaper competitor.
No, not at all. The rigorous certification required for these specific AI clusters means the switching costs are astronomically high. You simply do not risk a billion-dollar AI data center on uncertified second-tier memory chips.
Right. The hyperscalers are locked in, the pricing is locked in, the demand is structurally guaranteed for the foreseeable future.
Exactly.
But here's where it gets incredibly counterintuitive. We have a company printing $13.78 billion in pure profit. They are effectively sold out for the year with zero inventory risk. They've built an impenetrable technological moat. Yet the stock fell 2.6% during regular trading and then dropped another 5% in extended trading right after the earnings release. Wall Street looked at a flawless report card and decided to sell. Make that make sense?
I know, it sounds crazy. But to understand the sell-off, you have to separate the fundamental business from the psychological state of the public market.
Okay, go on.
This stock didn't just appear out of nowhere at this valuation, it tripled in 2025. And then it added another 62% gain so far in 2026, leading up to this earnings report.
It's been on an absolute tear.
It really has. The market capitalization swelled to $520 billion. That propelled Micron past legacy giants like Oracle in total market value. It actually became the only stock among the top 10 most valuable U.S. tech companies to be up year-to-date prior to this print.
Wow, so everyone was already heavily invested.
Right. When a stock runs that hot, that fast, it becomes what the market calls price for perfection. Every single bit of good news, every potential upside surprise, it's already assumed in the share price before the earnings are even released.
I hear that term price for perfection thrown around constantly, but I want to push back on the underlying market logic here.
Sure.
Let's say I own a private local business, like a specialized manufacturing plant. I just 10x'd my profit from last year. I have ironclad contracts guaranteeing I'm sold out for the rest of the year.
Right.
I do not wake up the next morning and sell my business just because I hit my aggressive internal targets. Why is Wall Street suddenly shaking out of a secular growth name when the underlying business mechanics are this undeniably strong?
Well, running a private business and trading a highly liquid public asset operate on completely different incentive structures.
Oh,
In the public markets, institutional traders, hedge funds, algorithmic trading programs, they operate on very specific technical levels and quarterly performance metrics. When a massive catalyst like an earnings report hits a stock that is up hundreds of percent, short-term traders take their profits to lock in their quarterly bonuses.
Oh, so it's just a cash grab.
Basically, it is a textbook sell the news liquidity event.
Mm.
But there is also a very specific fundamental fear driving this particular sell-off.
Mm.
The fear of the margin peak.
The margin peak, that's the idea that things are so incredibly good right now that they literally cannot get any better, and therefore the only direction left to go is down, right?
Exactly. The unnamed analyst downgrades we saw specifically cited this concern. Micron's gross margins are so historically robust right now that the market is terrified they've hit the absolute ceiling for this particular AI hardware cycle.
Right.
However, looking at the counter-narrative is vital here. At the exact same time as these anonymous margin peak fears were circulating, major institutional players signaled massive confidence. Bank of America raised its price target on Micron from $400 to $500 immediately following the earnings release.
That's a massive vote of confidence from a major player. They are looking at the exact same data and saying the stock has another huge leg up.
Yeah, smart money, the long-term capital allocators, they view this dip not as a fundamental breakdown of Micron's business model, but as a necessary and healthy shakeout.
Getting rid of the tourists.
Exactly. It clears out the weak hands, the retail investors and short-term momentum traders who panic at the first sign of red, and it establishes a much firmer base of long-term holders for the next leg up.
Let's dig into that margin peak fear, though, because it isn't just a ghost story that algorithmic traders tell each other in the dark to justify selling. It is tied directly to what Micron is actually doing with all that new cash.
Right, they are spending it. The capital expenditures, or CapEx, are staggering. Micron just boosted its 2026 capital spending plan by an additional $5 billion. That brings their total expected spend for this fiscal year to over $25 billion.
$25 billion, that's with a B.
With a B. They are acquiring an entire fabrication plant from Taiwan's PSMC, and they are simultaneously building a massive new facility from the ground up in Boise, Idaho.
I want to frame this with another analogy. Because it feels like a hit restaurant in the city that is completely booked out every single night, the owner is making money hand over fist. But instead of just banking the profits and enjoying the incredible margins, the owner takes out a massive loan to open 5 new, gigantic locations all at once across the state.
Okay, I see where you're going.
It's brilliant if the crowds keep coming. But if the public's appetite for this specific cuisine suddenly shrinks, the owner is left with 5 empty restaurants, enormous overhead, a huge staff payroll, and massive depreciation costs that instantly drag the entire business into the red.
Are they building too much, too fast? Are they overestimating the longevity of this AI boom?
At bear case is exactly what caused the institutional hesitation. If AI data center demand slows even slightly, that $25 billion capex bill transforms from a growth engine into a massive financial anchor. But your restaurant analogy misses one absolutely crucial detail regarding Micron's balance sheet.
Oh, what's the missing piece?
In your restaurant analogy, the owner took out a loan to fund the expansion.
Right.
Micron is not borrowing money to do this. They are entirely self-funding this massive $25 billion expansion through their own operating cash flow.
Oh, wow.
Remember the $13.78 billion net income figure from earlier? That was generated in just one single quarter. They have the cash on hand.
So there's no dead anchor dragging them down. Exactly. Furthermore, they are essentially forced to spend it. The high bandwidth memory market is structurally undersupplied. Current supply chain checks and industry rumors suggest these HBM shortages are going to last well into 2027.
So they have to build.
If Micron chooses not to build capacity right now to capture that guaranteed demand, they permanently forfeit market share to their competitors in South Korea. The heavy spending isn't reckless ambition. It's a defensive, existential necessity to capture and hold the highest margin product segment in the world.
Okay, when you lay it out like that, the spending makes complete sense. And even with all that capital expenditure and the massive run-up in the stock price over the last year, the actual valuation of the company isn't stretched, is it?
Right.
Like, we aren't looking at some bubble valuation where the stock is trading at 100 times earnings.
Not at all.
Yeah.
Despite triple-digit revenue growth, Micron's forward price-to-earnings ratio is sitting around a highly reasonable 13x based on the February data.
And for anyone new to that metric, the forward PE ratio is just a way to measure how expensive a stock is compared to the cash it's expected to generate over the next 12 months.
Exactly. For a typical mature tech company growing at 10 or 15% a year, a 13x forward PE is considered cheap.
Right.
For a company growing its top-line revenue at 194%, a 13x forward PE is almost unheard of. It represents a massive dislocation between the actual earnings power of the company and the price the market is currently willing to pay for it.
So the internal fundamentals are screaming buy, the valuation is incredibly reasonable, and the growth runway looks solid into 2027. But as you just mentioned, $25 billion is a massive bet that the global economy stays stable. And right now, they are making that bet in an incredibly volatile geopolitical climate. We have to look at the immediate risks ahead because Micron is swimming in a very unpredictable global ocean.
Yeah, the macro headwinds are severe and entirely disconnected from Micron's internal performance. The data highlights the ongoing conflicts, specifically the impact on global energy markets. with oil prices recently spiking to $119 a barrel.
Walk us through the transmission mechanism there. Why does a conflict overseas and a spike in oil prices cause a semiconductor stock in the United States to sell off?
It's all about inflation. When oil spikes to $119 a barrel, it acts as a massive, immediate tax on the global economy. It drives up inflation.
Right, everything costs more to ship.
Exactly. When inflation threatens to spike, the market assumes the Federal Reserve will have to keep interest rates higher for longer to combat it. Higher interest rates mean the discount rate used to value future corporate earnings goes up, which mathematically lowers the current value of stocks.
Makes sense.
This creates a broad, risk-off environment. Institutional investors look at the geopolitical chaos, reduce their overall risk exposure, and pull capital out of the market, regardless of how good any individual company's earnings report was.
And highly valued tech stocks, especially semiconductor and memory makers like Micron, are what we call high beta stocks, meaning their price movements are wildly exaggerated compared to the rest of the market. If the S&P 500 takes a step back because of inflation fears, a high beta stock takes a flying leap backward. They amplify the broader market's anxiety.
Yeah, they act as a magnifying glass for macro sentiment. If the broader market sneezes, high beta tech stocks catch a severe cold.
This brings us to the ultimate question for the listener who is trying to actively build wealth. How do you handle this kind of cross-current? You have pristine, historic company fundamentals crashing head-on into scary global geopolitics that are dragging the broader market down. Do you sit on your hands and wait for the macro dust to settle, or is this temporary fear-driven dip exactly the discount you've been waiting for?
This requires looking purely at market mechanics rather than trying to become a geopolitical forecaster. Historically, macro-driven sell-offs provide the absolute best entry points for fundamentally sound companies.
Because the business itself hasn't changed.
Exactly. The current drop in Micron stock price has absolutely nothing to do with their ability to manufacture HBM or sell it to hyperscalers. The external fear is just temporarily depressing the asset price. If we see any de-escalation globally, or if we get a confirmed soft landing narrative accompanied by a rate cut from the Federal Reserve, the macro environment instantly flips from a severe headwind to a massive tailwind.
Which means we need to look ahead to the next big catalyst on the calendar. We have the Q3 earnings report coming up in June 2026.
That June report will be the absolute moment of truth. The entire market will be scrutinizing their HBM shipment volumes to see if they are actually sustaining these record margins, or if the margin peak fears from the algorithmic traders were justified.
And they'll want to see updates on the expansion, right?
Oh, definitely. The market will also be demanding updates on the new Idaho facility construction and the integration of the Taiwan fabrication plant. Any acceleration in those production timelines will act as a massive positive trigger for the stock, proving that their $25 billion CapEx bet is already paying off.
So, if we synthesize everything we've unpacked today, the gravity-defying 194% revenue explosion, the sold-out AI memory moat driven by the von Neumann bottleneck, the $25 billion self-funded capacity gamble, and the scary geopolitical macro environment dragging down high-beta stocks. Where does this leave us on the final investment thesis?
Synthesizing all the data from the institutional analysis in the earnings report, this setup grades out as an 8.5 out of 10 bullish thesis.
8.5, that's strong.
It is. The underlying transition is real and permanent. Micron is no longer a cyclical commodity player at the mercy of boom and bust cycles. It has positioned itself as a structural, foundational winner in the build-out of global AI infrastructure. The target horizon here isn't a 3-week swing trade, it is a multi-year hold. The current weakness we are seeing in the stock price, driven by short-term CapEx fears and broad macroeconomic headlines, presents a highly compelling accumulation point for long-term investors. When you combine their record-breaking operating cash flow with a forward PE of just 13, alongside top-tier institutions like Bank of America targeting a move to $500, the multi-year upside potential far outweighs the near-term macro volatility.
It truly is a remarkable story of a company perfectly positioning its technology at the exact right moment in computing history. And I want to leave you, the listener, with a final provocative thought to mull over on your own as you digest all of these mechanics. We noted earlier that high bandwidth memory and advanced packaging now make up a staggering two-thirds of the physical cost of a top-tier AI GPU.
Yeah, two-thirds.
If the memory component is now the vast majority of the physical value and complexity of these systems, at what point does the memory company become the true kingmaker of the entire AI revolution, rather than just the high-profile companies designing the processors? Who really holds the power when the engine block becomes more valuable than the car itself? Something fascinating to think about. Remember to subscribe, like, and comment to support your wealth building journey, and we look forward to exploring the next big catalyst with you soon.